All right. So, hey everyone. It's been a while since I've done a video, uh, general, but really, what I want to do here is just kind of go through two. So, hey everyone. Oh, now I'm hearing myself. That's weird. All right. So basically, sorry about that. I'm working on two financial models right now. So, pretty much until up until I got to equity research, I didn't really know how these work. There's those standard sort of like three statement financial models that you get taught at places like Wall Street Prep, but they differ from models that are used for equity research purposes. So I figured I'd try to build a few on my own just to kind of keep the skill set sharp here. Okay, so let me share my screen one. Okay, so I mean, typically the way I've been taught how to do this is you start with your income statement, and this ultimately feeds your EPS estimate. So that's what I have down here in this blue shaded line, and then just said EBITDA. So this is for HIPO Insurance. It's a new company. They just SPAC'd last summer. They do home insurance primarily in California and Texas. There's really not much info that they provide compared to some of the traditional carriers, but I thought it was an interesting kind of new company. Figured I'd try to forecast their earnings out. But as you can see here, as I'm scrolling kind of through the model, there's a lot of parts that are missing. That's just due to the limited amount of information that's available. So their S1's available, and they've got their second and third quarter earnings uh, results posted on the SEC website. But essentially, I got down to a point where I was able to create a few drivers. So really, the only thing that I've seen in terms of guidance as far as this total generated premium line item. So for 2021, management's guiding to about 600 to 605 million. So that's what I have sort of built in here for the time being. And um, revenue is basically driven by that figure. So I scroll back down here, it's basically a net premiums earned as a percentage of total generated premium. So I'm sticking with 7%. That number can change. Obviously, my knowledge is limited at this point, but seems to be growing. In terms of generated premiums overall, have it growing from 600 to basically doubling every year, more or less. But the more interesting part that that I've seen in terms of the results that I'm coming up with is their earnings are slated to be worse in each year up to 2024, which I thought was interesting. Again, don't really have any much information to go off of, but this is still a work in progress. I think the other model that I wanted to kind of share is Morgan Stanley. So I created this based based on some interest. So basically, a friend was interested in doing some forecasting of Morgan Stanley. So I've got essentially the actuals in here, as well as this four segments. So they've got institutional securities, wealth management, investment management. Then you have an intersegment eliminations kind of reporting segment. So this is like corporate other that you would see in other financial services companies. And really there's no one, I guess, way to kind of forecast each of these line items. So what I've seen is a few different things. So you can hard code a number, just say, I think for this segment, investments revenue is going to be 40 million. You just do that going forward. The other thing you can do is you can do a growth rate. So right here, I have trading revenue year over year growth. So I can take last year's times 1. So basically, if I hard coded 15% in there, I think the revenue growth rate is going to be 15% over year over year. Do that going forward as an alternative, or you can hard code a number too. So 3,000. Make that blue so I don't forget. That's a hard coded number. So lots of ways to kind of do it, but essentially, this is sort of the template that I've been using on my old team to build out the models. So essentially, what at least for banks, there's two main components of revenue. One is your non-interest revenues. So this is basically built off of the way that Morgan Stanley reports it. So these are fees and commissions generated from activities such as investment banking, trading, and other areas. And then you also have a net interest line. So essentially, this is the core banking business of trying to borrow funds at one rate, hopefully at a lower rate, and lending them out at a higher rate. So that's what's captured here. And then you've got your non-interest expenses, which you can either hard code or you could take it as a percentage of revenue. And that's sort of a judgment call in terms of what you think is most appropriate. And below the income statement, so I've got my headline EPS row over here. Below there, below the income statement, I've got your balance sheet. So I'm going to try to use this to do a few different things. One is I'm going to essentially take a ratio of interest earning assets as a percentage of total assets, and kind of use that along with an assumed rate to get my net interest revenue. And then you also have your cost of funds. So this is on the liabilities of the balance sheet. Again, there's going to be an average rate that you're going to pay going forward, which is hopefully less than the rate that you're lending at. And then you earn a spread off of that to get to your NII. So essentially, I've got a lot of work still left to do here, but I think I should be able to finish this in the coming days. One of the trickier parts for me was doing the wealth management fee income. So basically what I've done here is a few different things. So I've got a roll forward of client assets that's provided in the financial statements for different areas. So you've got your separately managed accounts, advisor accounts, etc. Then I've got this total here, rows 83 to 87. And essentially what I'm doing is getting an annualized fee. So this is asset management fees divided by the average of the beginning and ending balances. So I'm basically trying to back into a rate, which then, given the trends, seems to be some fee compression here where it was over 1% and it's been heading into the mid 80s. So, I can assume, 80 basis points going forward if I want, or I can pick a number. Try to look for management guidance somewhere, whether it's in the earnings transcript commentary, maybe they mention a number, or maybe it's buried in the press release somewhere. So that's essentially where I'm headed in terms of this segment. And I'm not trying to like capture all the drivers of revenue, at least right now. I kind of want to just leave it at a basic level, get it up and running. And really, if you look at it for this segment, at least, the asset management revenues are the most meaningful. So, I can hard code like these line items, 50, 10, do that. And then basically come up with a projected fee. So I say 80%, 80 pips. And then this is a plug. So I'm gonna have to, what? Hard code this in for now. 50, 25, that looks good to me. Market impact. That's going to be hard to project, I'll be honest, but fourth quarter 21, overall, it was a fairly okay market environment. So I'll throw in the 20 in there for now as a placeholder. But again, I guess the idea here is just to kind of keep it basic. And basically, all right, so basically show you the mechanics of how this works. Again, a lot of this was new to me before I actually got into research, so it's kind of cool to kind of share that knowledge, because there's a lot of models floating out there that are more geared towards like M&A, LBO, like more transactional models. I think there's less of I guess the traditional sell-side research models floating out there. So I don't consider myself that good of a modeler anyway, but it's definitely a big part of the job. I strive to get better, and it's just done through repetition and experience, like most things. So, all right, so we've got one. This is in billions. All right, so we got $1.8 trillion of. All right, so you take n times 1,000 multiply by n90, and that should be that gave me a really wild number. Actually, hold on. Should be the average. So taking the average. Taking the average of 7 times and 90 by 4. That's because, okay, this is an annualized fee. Okay, so we're taking the quarterly version of that. So times 1,000 to convert billions into millions. There we go. All right, so again, that's just one piece of the pie. Next thing is figuring the interest income. So there, again, I guess when you're making a model, you can either choose like a top-down or a bottoms-up approach where you forecast everything at the segment level. So if you want to forecast your interest income and interest expense, you can do that. Or what I'm probably going to do here is do it at the consolidated level and then take the historical segment NII and use that as a rough guide for percentage of consolidated. So you can allocate it to the segments. So great part about this is you can use a little bit of creativity. There's no sort of like one way to kind of do this. And there are multiple ways to get it to a number. But yeah, I think I'm gonna start doing some more work on this maybe for the next hour, half hour or so. See how far I get along. Oh, the other thing I wanted to share. So I don't have any access to BAMSEC anymore, unfortunately, but I do have Ticker, which has been pretty useful in terms of they have a lot of segment information in here, which I think is cool. So you can do kind of like a rough guide on a quarterly or annual basis to see how different segments are performing, which is kind of cool. And then Wallmine is what I've been using. This is sort of like my poor man's version of BAMSEC. Still requires a subscription. For the most part, it's just as good, but not as good since I've been working in BAMSEC a lot the past 6 months or so. So, cool part about this, it's got some of the similar features in it. So if you have let's say you have a table, you can copy and paste this into Excel. You can download it as a spreadsheet if you want. So if I wanted this table as a spreadsheet, open it up. Here's my spreadsheet. Pretty cool. Or you could copy and paste directly into Excel. So I think I did that for something else, but it's pretty convenient too. And you can find similar tables, although I think BAMSEC is better in my opinion, but gets the job done for the most part. All right, so that didn't work there, but it usually works. Here we go. So you can find tables that are similar prior filings, which is kind of nice. But yeah, so I've been working on this thing for the better part of 2 weeks or so, past 2 weeks, but it's just been a challenge because of some stuff that I've been trying to do for school and also the job hunt grind. Lots of interviews and coffee chats with which have been extremely useful. But yeah, so this is essentially what I wanted to share. If anyone has any input, I'd love to hear how other people kind of approach their models in terms of forecasting, what they use, especially in the financial space. Because again, I haven't seen anything. I've seen one way to do it, or at least a handful of ways, but there's probably a lot of other different ways. And then I think in terms of what I want to build out here is having the revenue line items and getting the P&L set up at a high level, in terms of banks, risk-weighted assets is a big deal. So that drives your capital ratios, and something that management pays very close attention to, as well as, your SLR, you've got liquidity ratios and all that stuff. So I want to build that into here So I'm thinking LCR as a short-term measure. That's a ratio that's pretty closely followed. And I'm sure it's followed on the street as much, but internally at a lot of banks, it tends to get some eyeballs. But yeah, uh, so essentially that's that. Thanks for viewing. Tends to get some eyeballs. But yeah, so essentially that's that. Thanks for viewing.